It's the interview series. The interview series. It's the interview series. It's the interview series. The interview series.
Welcome to the interview series, where the mission of this podcast is to add value to as many people as possible. As a realtor, investor, and consumer, I know firsthand there's a lot of information out there and not a lot of time to verify and consume it. So I created this podcast to ensure you have the resources, information, and knowledge to alleviate any stress as it relates to real estate, finances, and more. So with that being said, it's an honor to introduce Joseph Huang. You're a commercial lender, but before I ask you a few questions, grew up in an entrepreneurial family setting, learned the value of money and investing at a very, very young age, which is important. So I can't wait to pick your brain on that. And earned an executive MBA from Sonoma State University in 2018. Have been in banking for 17 and a half years, and 10 plus years of those I've been a commercial lender. All right, so a lot of my clients are looking in the residential space, right? So I think the first question I have to ask for the viewers out there is, what is the main difference between residential and commercial lending?
Yeah, so thanks for having me here, first and foremost.
Yeah.
But the main differences are when you have essentially 1 to 4 units, typically by an individual, those are typically going to be residential type lending. So what I usually do is I focus on 5+ units, so a lot of apartment buildings, commercial real estate in terms of office space, industrial, mixed use. So anything outside the scope of your typical 1 to 4 single family units.
Got it. So you're looking at 5+ units and more.
Absolutely,
right? Okay.
absolutely. Or in some cases, from an investor's perspective, they may end up wanting to buy a single family home or a duplex or a triplex, and they want to have it held in an LLC or some type of holding company. So that's when I would be involved.
Got it. Okay. Appreciate that clarification, right? I think the common consumer wants to kind of see what's the difference and, when do I need a residential lender or broker versus when do I need a commercial lender? So that
Absolutely.
Clarification is appreciated. And so I think as a realtor, we have, I said this earlier, I was thinking that, you could step outside, there's a joke going around, you can step outside, throw a rock and you hit a realtor, right? So there's so many realtors out there that, everyone has to have their own individual process with their clients. And so I'll sit down with my client and I'll do my thing. Another realtor will do their thing. So when I ask you this next question, can you walk us through your, not the commercial lending process, step by step from A to Z, but what's Joe's? Like, what do you do with a client to kind of get them familiar with what you're going to offer them, how you're going to serve them?
Sure, yeah. So typically what I like to do is treat them kind of how I want to be treated, and that's to be able to have all the information so that I can make an informed decision. So the process is, if it's their first time buying a piece of commercial real estate or working with a commercial lender, what I try to do is kind of set expectations in terms of timelines as well as to what to expect. One of the things that's much different that you'll see and buyers will see in commercial real estate is that the timelines are typically a little bit longer than they would be for a residential transaction. So the reason being is that on, let's say a commercial building, what we want to do is we have environmental. We need to make sure that the environmental aspect, that if it was a gas station, or if there's a laundromat with dry cleaning services, a print shop, commercial print shop. So there's that environmental element that we have to also factor in. And then the second that takes a little bit longer is usually the appraisal. So the commercial appraisals, they can take anywhere from as quick as what you might see residential in 7 to 10 days, and then sometimes, earlier this year we saw they were kind of coming back 45 days, 40 days as quotes. And so it kind of just has a slightly different time horizon, but it's really my job to make sure that I know what those time frames are for that moment in time, and to set those expectations with all parties that are involved. So that way, we're all on the same page. Once I do that, I also want to make sure that we get all the upfront financials for the buyer, as well as on commercial. We also look at the rent rolls from that subject property, because that property itself will be the primary source of repayment, and so that's why it's going to be really important to have that as well. But once we we have those up front, what I want to try to do is make the underwriting process, as short but as concise as possible. And having the information up front is going to be really the key that drives the process smoothly and in a short, quick manner.
Can we go back a little bit to rent rolls? Can you explain to the viewer out there, like what's a rent roll in your world, and how can you make it make sense for us?
Yeah, no, absolutely. That's a great question. So a rent roll is essentially just a list of all the tenants that are either in a commercial strip center like what we're at here, or it could be, let's say, a 20-unit apartment. So it would literally just list out, unit 1 through 20, who's at each of the units, and then when the lease, when they started, when it ended, and then if there's any options potentially, as well as what they're paying, per month. So what that does is it just kind of gives you a roll at the very end, or a roll up of all the rents that are being collected. So
got it. Thanks for that breakdown. I appreciate it.
Yeah.
Let's just hypothetically say that I have a buyer that's interested in like a commercial property, 5 units, 6 units, or more. What would be something that would get in the way of my buyer's qualifications for that said property?
Sure. Yeah, so I'm sure we've all heard that cash is king. Well, cash flow is queen. So cash flow is going to be the main driver in these instances. Most lenders will look at the cash flow that the property will actually receive, and then that'll be used as the primary source of repayment. So where we run into issues is where there's vacancies, where there's tenants that are collecting below market rents, but then they're trying to sell the property for market price. So that's kind of where we run into issues for buyers, is that the economics doesn't align.
Okay. And I have a follow-up question with this. And so let's just say since we have to rely on the queen, which is cash flow, let's just say I don't have a queen.
Okay.
And I want to purchase a commercial property that obviously that relates to 5 units or more. How do I qualify if I don't have cash flow, or do I need to work on earning? Like, what does that look like for someone that doesn't have any other investments? Or are you looking at income from my job, or what does that look like because I don't have cash flow outside of my going to my 9 to 5 or the job I'm in?
So in situations like that, we'll have to take a look to see what other assets or properties that the buyer may have, because if there is other properties, we can utilize potentially a different property to be able to achieve what they're trying to get, which is enough cash so that they can acquire the one that's the subject. Now, if not, let's say they're just looking for their first actual investment outside of their home, then we're going to have probably other lenders that work in different spaces. You've got bridge lenders, you've got private lenders that might have to be utilized so that they can acquire the property, and then they come back to a traditional commercial lender like myself that can help them with their permanent financing. So typically, just to take a step back, traditional banks and traditional commercial banks, we definitely look at cash flow as a driving component to qualifying buyers. And so with that understanding, if there's a shortfall in terms of cash flow, then either A, we realize that the price of the property may be above value that they're asking for, or in some instances there's just vacancies, so they need a bridge loan from a bridge lender so that they can fill those vacancies and then come to myself to help them.
Got it. And this might be a little redundant, so forgive me, but
Yeah.
if, with that being said, if so they need cash flow prior to qualifying, in order to qualify for that future property. And so my question is, we can't find a property that will cash flow and use that as future qualifications? Does that make sense? Where like
yeah.
if we find one that like, oh man, these numbers make sense, it's going to cash flow. I don't have one yet, but I'm going to. Does the future, is there any account taken for the future?
I see. Yeah, so it depends on the lender. Okay. So some lenders have a greater risk appetite, and so what they'll do is they'll say, typically we'll see that in apartment complexes, because we know that in places like Northern California that there's a shortage of units for housing, and there's a high demand for it. So some lenders may be more comfortable and they say, okay, well, there's only a 15% vacancy, 20% vacancy. Not that we usually see that, but if that was as an example, then a lender might be comfortable and get behind and say, you know what, we know that the vacancy rate's only 3%, 5%. And if that's the case, and they can really rent those out relatively quickly, then a lender might get behind that. But if it's like a 4-unit, 6-unit, and you've got essentially 3 of those units empty, it's going to be tough.
Yeah, that makes sense, and that's a really good distinction. So people that are interested in jumping into commercial real estate, they understand there's options and there's flexibility depending on what they're getting into. So
yeah, absolutely, and it's at the end of the day, it's what does that property generate in terms of cash that can help pay the loan payment.
Yeah. And so, I'm kind of well-versed in the prepayment penalties. From a residential perspective, what does it look like from a commercial perspective, like from a prepayment penalty standpoint? Do you have products that have prepayment penalties, or are they specifically is that kind of something that used to happen back in the day?
Yeah.
Like, how do prepayment penalties work in the commercial side?
Yeah, that's a great question. So typically on commercial real estate loans, we do see prepayment penalties. A lot of times they're going to be tied to the period in which the rate is either fixed. And so, for example, in commercial real estate, we'll see a lot of loan structures that are 25 years in amortization, but they have a 10-year maturity. And during that 10-year period that the loan's good for, sometimes they might have 2 5-year fixed periods. They might have a 10-year fixed period for the entire duration. And so we typically see commercial lenders will set their prepayment penalty to the fixed rate period. So, and it's typically on a sliding scale. So what we see is like on a 5-year fix, we might see a 5, 4, 3, 2, 1. And that means if you paid off the loan within the first year, it's a 5% prepayment penalty. If it's paid off in the second year, it's 4%, 3% the third year, 2% the fourth year, and of course 1%, the fifth year.
Got it. Okay. And then I think you mentioned it a little bit earlier, I might have missed it, but timeline to close a transaction. I'm assuming it's a little bit different than the residential side.
Yeah.
How long does it take to close a transaction?
Yeah, so when you look at my experience, I have had a borrower who was really on top of what I needed from them, and I was able to do an SBA real estate purchase beginning to end 45 days from
SBA, what's SBA? Sorry to cut you off.
Oh yeah, so
SBA.
SBA is a loan that's backed by the Small Business Administration, and so they work alongside with a lot of banks by essentially guaranteeing a portion of their loan that they've made to a borrower. And so typically with SBA loans, we hear horror stories, and I think a lot of it has to do with the financial institution you're working with, as well as the experience of the lender that you're working with. Because having a lot of that information up front and the knowledge can really help kind of make things much less frustrating and avoid delays. So to answer your question, we can go 45 days from beginning to end to, I've seen 75 to 90 days. So it just kind of depends on on how motivated and how responsive, folks are.
What's the shortest?
It's about
Time?
about 45
45.
days.
So you don't rarely see anything shorter than 45.
It's very uncommon to see things less than 45,
Yeah.
although it is possible.
Got it. Okay. Good to know. Difference between commercial loan rates versus residential loan rates. What is there a difference? Are they the same exact thing?
Yeah, there is typically a slight difference, and it kind of depends on the property type. So for, commercial office space or, industrial complexes, those units, they tend to be a little bit higher than what you would see for residential mortgage rates. You're usually within 1% typically. But it can definitely depend on the timing. But now where you might see some below is on apartment complexes. Mm-hmm. So I've seen apartment complexes typically if we're talking about 20 plus units, a lot of times they're priced below what a single family resident loan may be, like on a conventional mortgage. So,
and I got to put you on the spot here. Why? Why would they be, less, and why would they be more? Like what?
Yeah.
I guess I can ask a two-part question and say
Sure.
what attributes to the pendulum swing, but like why would it be higher or lower? Why wouldn't it be the same?
Yeah. So one is the indexes that the banks typically use for pricing the mortgage rates versus a commercial loan rate. They use different indexes. And then the second is that, when you have 20 units, let's say, if you have 4 or 5 tenants that end up leaving, you still have 16 payers, that are making those monthly rent payments. So your risk as a lender is definitely, distributed amongst, 20 units versus just maybe one. So that's another factor.
So it comes down to risk mitigation.
Absolutely.
Got it.
Absolutely.
Makes sense. Totally get that. And the question I'm sure you get a lot, maybe not. I know I get it. Where do you see the market going in 2023?
Oh,
If you had a crystal ball.
That's the crystal ball question. All right. Well, that's a tough one, but I do feel personally that from what we're seeing in a rising interest rate environment, that it's going to start creating a lot of pressure, downward pressure on real estate prices. So you've got those two factors. The federal chair, Jerome Powell, said that they're dedicated and committed to reducing inflation. And so we do anticipate that in 2023 that he's going to continue raising interest rates, maybe not at the degree that he has in 2022, but we do expect that. And with that, we'll continue to have pressure towards pricing, because as an investor, it's all about your ROI, your return on investment. And so if the cost to borrow is going to be higher, then something else has to give.
Makes sense. Yeah, I love it. Can't wait to fast forward to 2023 to see if your predictions are correct. I love it.
Well,
and I know you're basing it off of things that we've already heard and whatnot, which is good to kind of use that data. So, and then honestly, at the end of the day, it doesn't matter. We're going to act accordingly with whatever happens.
Absolutely.
But,
Absolutely.
I had to ask in your experience because you've been in the game for a while. So
yeah.
I appreciate that. In addition to your experience, like with those that do want to know, like what advice would you give those who are looking to buy their first commercial real estate property, or
Sure.
just, I guess, increase or grow, I should say, their real estate portfolio? What advice would you give them?
Yeah. So, going into 2023, what I'm seeing, as well as what I would say is advice for those that are looking to buy real estate, is making sure that if you're buying it as an investment, to make sure that the economics make sense. So, the amount of money you're putting down and the rents that you can collect, that makes sense. And if that's in alignment, then that's the first important piece. The second is you have to have reserves, cash reserves, because in the event that you have turnover in your tenants, in the event that something happens and you need to fix, you got a water pipe that broke or a roof that's leaking, you got to have cash reserves, and those are what's going to help you and help investors weather those storms, whether it be a few months, or a few quarters. So that's kind of where you just want to make sure that you've got those reserves. But yeah.
As an investor myself, right, and one that wants to invest, we've sat down and talked about my future, right, and just how I can get into the commercial real estate game. But is there a recommendation or maybe even a requirement on how much reserve you have to have in order to kind of move forward into real estate, commercial real estate?
Yeah, I mean, I would definitely say you want to have 3 to 6 months of reserves, for yourself on those properties.
Now, per unit or per
property?
Okay.
Yeah.
Okay.
Yeah.
I didn't know. Okay. I guess I got the maths out.
Yeah.
Right.
Yeah,
It doesn't matter whether it's per door, but so okay, makes sense. So 3 to 6 months. Okay. What about some success stories, man? What are some success stories you could share that could potentially inspire someone to, jump into commercial real estate, to build their wealth? Like I said, through commercial real estate. What have you seen out there?
Yeah. So I've had the fortunate opportunity to work with some really, really successful clients, which allowed me to kind of learn as well as draw inspiration from. What I've seen as a common thread is that they definitely do not over leverage. So when they start buying properties, they're buying them with down payments. They've got reserves, and they typically say that your first 3 to 4 are going to be struggles, and they're going to be tough, and you're not going to really, I guess, experience the fruits of your labor, so to speak. But once you kind of have 4 and then you start going beyond that, then the momentum starts to really build and the cash flow starts to really flow, and that's where they're starting to see success. And so, most of them that are independently wealthy, that don't have to really worry. It's a lot of hard work and just being consistent with investing and continuing with that, not leveraging.
Yeah, I think there's a lot of people out there that hear that it's all now. I mean, that's kind of, if you want to go on Instagram and YouTube videos, everyone's like, get into real estate. How can you create this passive income so one day I don't have to work? And I think it's important to talk to those that work with those people, right? So you can kind of see, the origin story behind it, right? Not just the flashy lights of passive income, real estate. Like there's a process. It's a journey, and even when you make it, you haven't made it. You're still kind of, playing with your portfolio, so to speak, right? So you can kind of always grow, and since you always watch it, and then the market dips, and so it's just like this lifelong process as opposed to this quick, way of getting rich, right? So I think real estate again is a long-term play, but I know you've seen some success with that. Any other tidbits or anything else that you want to share with our audience that you think that would be helpful, or that you think it just might be some insightful for them?
Yeah, I would always say that you always want to ask as many questions as you can and surround yourself and get different viewpoints from different individuals, because there's always going to be some lens that somebody's looking through that maybe you haven't looked through before, and that might help open your eyes to that specific property, or maybe some risks that might be you have to factor in your decision. The second thing is having your finances in order. That's going to be really, really important. So typically you're going to want to have your 2 years to 3 years of your tax returns, and if you have other partners or folks that you invest together with, that they also have their finances in order. Because what happens is when you find a property that you want to be able to move on it, and you want to be able to have your lender be able to essentially get you the loan decision that will help you achieve by acquiring that property.
Yeah, I think that's great. I think that's awesome. I think, yeah, finances are a big piece. And I know we didn't really talk about it too much, but I was reading an article the other day that said the average car payment for a new car purchase is about $718 a month. And I think when you think about some of the clients that I hear, obviously particularly in California with the prices of interest rates and the prices of our homes nowadays, even with the interest rates being low, that payment's so high or that price is so high. Well, if the average person didn't go and get, wasn't in debt, right? And really kind of looked at their finances as a globally, like as a whole, holistically, I think they'd be far better off to kind of qualify for whether they're trying to get into the residential space, which could then kind of help them get into the commercial real estate space. So when you say get your finances in order, that's where my mind goes straight to. I think this is great information for those that are listening, but finances, in my opinion, are like 80% behavior and 20% head knowledge. And that 20% head knowledge is somebody calling you and say, hey, I got my 80% down, help me get to that next level. And so I think that's where that's where the success comes from, is handle what you're supposed to handle, control what you control, and then what you don't know, go see an expert that can kind of guide you further.
Absolutely.
Yeah, when you're broken, you can't. There's not much you can do to fix the situation. So fix your stuff, and then come, and then maybe even before too. You can also kind of sit down with someone that can tell you, but there still might be some fixing that needs to be done prior to going and moving forward, which is okay. If you can sit with someone, and someone like you who genuinely cares is going to sit down and say, hey, you're not there yet, but we're 2 years away, we're 2 months away, we're 6 months away. I think that's big as well, as opposed to being ready too, right? So whether you're ready or not ready, I think sitting down with someone like you can be beneficial for their long-term growth and long-term, financial real estate portfolio and plan, right?
Yeah, absolutely. Yeah, a lot of it's understanding why, because you're always going to run into bumps and challenges, and sometimes you're going to get a no for a loan decision, and being able to understand the whys is going to be really important, because then you can kind of make any course correct adjustments that's necessary for the next project.
Yeah, sometimes we just got to get out of our own way, right?
Yep.
And not put go into crazy amounts of debt. But no, I appreciate your time. Before I let you go, where can they find you? What's the best method of contact for them to reach out to you if they have any questions? It's time to now let them know. Yeah,
absolutely. They can definitely reach out to me. My number is 707-318-9718. So they can reach out to me directly, and then I can also provide you my contact information as well, so you can provide that.
Perfect. Yeah, sounds good. I appreciate you, Joseph. Thank you for your time. Thank you so much.
Absolutely.
Take care now.